All right, thanks, Eric. Now, I heard yesterday that you're kind of getting tired of PowerPoints. Is that right? Okay, I know it's only 8:30 in the morning, but is that right? Because I have a PowerPoint. I can use the PowerPoint, so, it's up to you. But I figured I'd just use the whiteboard instead. Is that okay? So what I've found is that if I can show you different sales ideas to go through when you're sitting down with your customers and actually walk through the benefits of an index annuity, it's probably going to help you, right? And that's what I want to do today is share a little bit about our product, but I got 30 minutes to really show you how to position the product in the sales process. And everyone here is familiar with the three-legged stool, right? Okay. Again, I'm going to be checking in. I didn't hear right over here, so by the end of the time, maybe we'll do a wave or something like that. But you got the three-legged stool, and you got the Social Security leg, you got pensions, and you got savings, right? Everyone's familiar with this. And when you talk about Social Security for income, a lot of people are going to depend on Social Security. In fact, for some of them, it might be the only thing that they get for income. But when you take a look at the statistics, we know that the trend is going to be that, I think it's by 2030, there are going to be more Social Security recipients than people paying into the system. Seems like something has to give with that. So, I'm not going to discredit Social Security, but people are thinking about, am I actually going to get that or am I not going to get that? And when we take a look at pension plans, I travel a lot with my job, and unfortunately, the day that United announced that they were getting rid of their pension plan, guess who had to travel with United? You know what the person behind the counter wanted to talk about? Their pension plan. All I wanted to do was get my ticket, check my bags, get through security, get on the plane, get to where I was going. The person behind the counter is like, can you believe what they did? They took my pension plan away. And for a lot of companies out there, people were dependent on income from their pension plans. And now those are going away. Kodak, I think, is the latest one, right? So when you take a look at the three-legged stool, here's a big old question mark. Here's a big old question mark, if I can draw. And it's really kind of dependent more on savings. So how do we help clients save? Because we know that typically clients, our customers, don't save enough money. Or their kids don't save enough money. Or their family members don't save enough money. So how can we help them with that? Well, when we take a look at the retirement nest egg, usually it's divided up. We might have stocks, bonds, maybe CDs. It's going to be all over the place. What I want you to think about doing with your customers is taking a portion of their portfolio and actually moving it into a guaranteed income stream. And when we take a look at the numbers, I saw a lot of people raise their hands for Series 6, Series 7. So you're used to the 4% withdrawal strategy, right? Everybody use that? 4% withdrawal strategy basically says that the chances of running out of money over 20 years is pretty limited. And when we take a look at a $250,000 nest egg, that's going to provide $10,000 each and every year. Seems okay. But when interest rates keep going like this, the 4% withdrawal strategy starts getting questioned. And in fact, you've probably seen different articles that say, hey, wait a minute, we might not want to use that 4%, we might want to use 3% instead. Has anybody seen those? Okay, a couple of people have seen the articles. So with the 3% withdrawal strategy, what am I doing? Now what I'm doing is I'm giving my client a 25% pay decrease, but I'm protecting their assets. I'm making sure that they don't run out of money because I'm being conservative with the withdrawal stream. Now, the good thing about insurance is that we have a lot of large numbers. And there are a couple of products that we have. One's an immediate annuity. I know, don't moan, don't moan. An immediate annuity, I can offer a 6% payout on this $250,000. And I can do it with the return of premium benefit. So you talked about the old term or the new term, kind of the same thing with the immediate annuity. If I could show your customer a way where they could get a 6% payout guaranteed for as long as they live, and if they predecease the expectation that they have, I'm going to give their beneficiaries all their money back that they didn't receive. Not a bad deal. And when you take a look at a 6%, well, now we're talking what, $14,000? Almost double what I'm getting with that 3% withdrawal. It's a life with installment refund payout on an immediate annuity. Looks pretty good when you start talking about it, that I can create a guaranteed income stream for as long as the client lives and actually give them their money back, give the beneficiaries the money back if they didn't receive their full premium. But people still don't like that because they feel that if I step off a curb and get hit by a bus after I've received 2 payments from the insurance company, I've lost. I've lost. So we've come up with a better solution, and I'm running out of space here, but what about a 5.25% payout for a 65-year-old? Basically $13,000 plus of income for your clients. $13,000, what's the catch? What's the catch, right? What I'm going to talk about sounds too good to be true for your customers. An index annuity will sound too good to be true because what's happened to interest rates? They've gone down. What's happened to the market? We see 200-point swings almost daily now. We didn't see those before. And if a country like Greece can have a major impact on the U.S. economy, that scares a lot of people. So let's show them how they can get 5.25% as a withdrawal for as long as they live, and there's actually cash value available for them if they decide they want to take all their money back. Sounds too good to be true, right? Well, let me make it sound even better. Everybody's got the three-legged stool, right? I can erase this. So Mr. and Mrs. Client, we know that we have this income challenge today, and we know that you have different choices that you can use to create income. What I like to do with my clients is create guaranteed income streams, something that are more predictable for you. Because after all, the marketplace today, the economic environment is really unpredictable. And actually, if you saw my slides, we focus on unpredictability. If you ask your customers if they expected to be in where they are today, if I asked them the question 5 years ago, how many people 5 years ago would be dead on where they're at today? No one. No one. If I asked you 5 years ago, would 1-year CD rates on a national average be only 60 basis points? How many people would say, yeah, that sounds about right? Wouldn't have happened. Wouldn't have happened. So if I can show my customers how to get rid of that unpredictability for retirement planning, that makes a lot of sense. And what we can do with our index annuity is I can grow their assets by 8% each and every year. So my $100,000 is going to go to 108, 116, 124, all the way up for 10 years up to $180,000, and that's guaranteed. It's funny. I represent 14 states for Genworth. I left a message on my voicemail, and I think Myra probably heard it, Eric heard it. I go, you know what? It's a great time to be selling annuities. And it is a great time to be selling annuities. When you take a look at what annuities can offer, it's a great time to be selling annuities. But somehow, my mother heard it's a great time to be selling annuities. And I told her, I go, you know what, it's funny. It's like I got to go change the voicemail and do different things with work. And she's like, oh, you can't change your voicemail. I'm like, what? She's like, I love your voicemail. It's so positive. It's like, I know you get great results from it. And it's true. I got great results from it. I was up 36% last year. It's not bad. But I told her, I go, well, let me tell you the story of what I'm going to replace that it's a great time to be selling annuities with. I said, if I could show your customers how to grow their money by 8% each and every year, guaranteed, for up to 10 years, and then when they decided to take an income stream, I could take that 8% growth that they received and give them 5.25% as a withdrawal for as long as they live, eliminating the fear of running out of money. Would that make sense? Would that make sense? Absolutely, right? And people say, how can you grow it by 8% each year? That's not possible. I've looked at every single thing out there. Your engineer clients, right? I've looked at everything out there, and there's no possible way that you can guarantee me 8% each and every year. So what's the downside? I am going to grow the money by 8% each year, even if my S&P 500 performance, if I had investments in it, went down to $80,000, my 8% growth is going to work for me each and every year. If they had left their money in their S&P mutual funds, their individual stocks, whatever, they would have lost money, just as an example. With this, I'm guaranteeing 8% growth. And now the catch is that when I take my 5.25% off this, or just over $9,000 each and every year, well, my cash value is actually going to go down. So my cash value isn't $180,000. On index annuities, we're going to kind of divide it up into two different ideas. One idea is that I'm accumulating cash value, and as the S&P 500 index goes up, my cash value is actually going to grow. And the other idea is that we're going to take the money that the client put in and create an income asset for them. So that income asset's going to grow by 8% each year. Their cash value doesn't necessarily grow by 8% each year. But when I look at drawing income out, I know I have a predictable 8% income growth to create that income stream for my customers. And since I know most customers, their number one concern is running out of money, I can help them with this. So that portfolio that I talked about, I'm not going to ask for the whole thing. But 20, 25%, I think we'd be okay with that. You know, you want to bring 25% of every single portfolio that you manage or oversee, we'd be okay with that at Genworth. You know, by the way, at Genworth, we're the number one provider of long-term care in the country by a long way. We issue the most life insurance policies out of every single company out there. We issue the most life insurance policies. In our annuities, we're a top 10 provider of annuities. We want to be in the top 5. That's why we came out with this index product. We're kind of late to the dance, we know that, so we had to make it better than everybody else. Okay, and I know I'm the company guy, and you're all skeptical about that comment now, right? Anybody skeptical about that comment? Okay. Joe, I'll give you $20 later. You know what? Yeah, exactly. Our niche is that for people that want income within the first 8 years, by crediting 8% simple interest, we're going to create the best income for the client. We aren't looking at a 10-year income stream. And Rich talked about Cheryl Moore at Annuity Specs. She is an industry guru. She knows a lot about income riders. She says that on average, clients hold this product only 1.4 years before they start income. 1.4 years. It's terrible. LIMRA came out with a study. LIMRA says 56% of retirees retired earlier than expected. Think about that. Think about your clients. The guy who oversees our sales desk, his father-in-law just decided to retire. You know what happened? His company changed leadership. They got merged into a different company. He didn't like it anymore. and he decided to retire. But think about your clients that have health conditions or someone in their family that has a health condition that they had to retire earlier. Things happen in life that we can't plan for. This product can work very well. By the way, you do have handouts in front of you. Secure Living Index 7 is a 7-year surrender charge product. Secure Living Index 10 is a 10-year surrender charge product. The plus on the 10 means we'll give you a 5% premium bonus, and you should have an income protection rider brochure as well. Pretty simple. 7-year surrender charges start at 9%. They go down from there. It's not a double-digit surrender charge. It's very consumer friendly. Now let me tell you a unique feature about the 7-year product that can help you sell. And with the 7-year product, we have a thing called a guaranteed minimum account value. Guaranteed minimum account value basically says that whatever you put in, I'm going to give you 107% at the end of the 7 years. So I just mentioned the CD story about 60 basis points on CDs, 1-year CDs. So Mr. and Mrs. Client, you told me already that you have money in the bank, and I know that banks are paying about 60 basis points on 1-year CDs. Is that about right? They'll tell you. Well, no, I'm getting 80 basis points. Woohoo! Okay, so if I showed you a product where I could guarantee that you're going to get 1% each and every year over the next 7 years, but I gave you upside potential of up to 4% this year, would that make sense? The 7-year product for $100,000, our annual cap is going to be 4%. Now, I know you probably all know about what index annuities do, but all that annual cap means is that at the start of the contract year, where's the S&P 500 index? At the end of the contract year, where's the S&P 500? If it went up, that's great. They get crediting on it, and they get crediting up to the 4% cap. If it went down, I'm not worried about that because I have this guaranteed minimum account value that the client's going to get at the end of the 7 years. So literally, if the cash value on the product is only $103,000 because we had 3 negative years and then had really poor performing years, I'm going to make sure they have $107,000 at the end of the 7 years. So this is a CD or a money market replacement idea that you can go talk to your clients about and say, hey, I know you want to have this safe money over here, but my job is to show you ideas on how you can have that safety as well as growth opportunities. And with this product, because it has this minimum guarantee, you can be sure that at the end of the 7 years, you're going to get at least 1% each year, $107,000. I think that's a nice story. And I think customers are looking for those stories right now. Now, I should point out, and we'll go to the slide. Where's the clicker? Here we go. Let's go to the PowerPoint real quick here. And I'm going to skip through a couple of slides here, guys. So, all right. Okay, let's do this. Index 7. Can everybody see that? Kind of little. I know Brokers Alliance has this on the website as part of the income calculator as well. But it points out that we have 3 different index strategies at the top of the screen. We have a monthly cap, an annual cap, and we also have a performance trigger strategy. One of the things that I wanted to point out, though, is that we have a bailout strategy. And I know you're very optimistic and no insurance companies would never decrease cap rates, right? But we put it in writing that we can't go below a certain point. That's what our bailout cap rate is. If we breach that bailout cap rate, which is based on the annual point-to-point crediting strategy, your client has 45 days to walk away from the contract. No surrender charges, no market value adjustments, no loss of premium bonus if they chose the 10-year contract. The bailout strategy is a unique feature to guarantee, again, you'll notice I'm talking about guarantees for your clients in a volatile market that interest rates have gone down. Guarantees are a great thing. The bailout rate basically guarantees that we as a company, if we breach that bailout rate, your client can take all their money and walk. No penalties. That's peace of mind for your clients because you have seen different companies decrease their cap rates, and when they need to make more money, they decrease their cap rates more. And when the economic environment turns on a dime and says, wait a minute, we're going to switch directions here, we, the insurance companies, normally have to scramble. And when you have most of the assets on an index annuity in a bond portfolio earning a set rate, there's not a lot you can do to scramble. By the way, everybody knew that's how it works, right? Put about 85 to 90% of the assets in bonds, just like any other annuity product, and then use the other percentage to buy options to make up that index performance. That's how the crediting is done. So your clients get choices with us. They get safety and stability with us as well. We talked about the bailout rate. I want to talk about the performance trigger as well, because the performance trigger strategy, the bailout rate is actually 3.1% on the 7-year contract. So if I have a $100,000 premium, my annual cap's at 4% today. If I go below 3.1% for the bailout, say 3.05, the client at reallocation time at the end of the contract year, they have a 45-day window. And we actually notify them what that cap rate is that they're going to get. The bailout rate is set contractually, so when the client gets the contract, they know that it's going to be 3.1. 2.1. The 10 year is actually slightly lower crediting, so 3% on the annual cap because we have that 5% premium bonus. So the bailout's 2.1. Question.
Do they get the accumulated value or just the premium back?
They actually get their accumulated value. If we breach the bailout rate, they get their accumulated value back. I wish we could give them the benefit base, but we can't. Any other questions? Question. Yep, standard 10% withdrawal, except in the first year, and this is a great benefit too of our product. If you have a client that's taking an RMD, we'll let them take that RMD in the first year. Any other type of withdrawal has to start year 2. No, by the way, does everybody here want a commission charge back when they take the RMD? Geez, I can't believe it. I haven't met an audience yet that wants a commission charge back in that first year. You can send all your money into us, let the client take the RMD in the first year, and there's no commission charge back. So think about it. How many times do you have to have your client take money out and then transfer the remaining money in? You don't have to do that with us. I had to ask twice on that one. I didn't believe them, right? I'm like, are you sure? Are you sure? They know me by now. They know if I ask a couple of times, I'm like, I'm not believing this. But it's in writing. It's actually in the contract. So great opportunity. Our nursing home provision, we actually allow for 20%. Now, I'm going to tell you, there are some big name companies out there that work with index annuities. And they do a good job. And everybody expects that they're going to keep doing a good job. But you know what? We're here to play. We're here to play. I'm going to invite you to do a comparison. The companies that you're currently working with, send us their quote, or send Brokers Alliance their quote, and compare it to our product. I know that when you look at the bailout provision, when you look at the performance strategy, when you look at the RMDs, when you look at everything about this contract, the 8% simple roll-up, our numbers look really good. And that's not the 7-year product. Great. GMAV works really well for those CD or money market options. When you take a look and clients looking for income within the first 8 years, we're going to perform better. We're just going to perform better. Now, I do need to point out, and this is where I'm actually going to go forward about 10 slides here. So, oh, wait a minute. I do need to talk about commissions, don't I? I should probably do that. Eric, I can talk about commissions, right? Go for it. Okay. You want to make money? Okay. I like people making money because then I'm making money, right? And I have trail commissions up here. And I got to tell you, I'm not normally a big fan of trail commissions because what happens with trail commissions? Well, I get my 5% over the next 7 years. Pretty awesome. With our product, you can actually make a lot more money with trail options. And let me paint a picture for you. Over the accumulation period, over the next 5 years, my client is building their nest egg up. They're looking at income, and they want that 8% growth each and every year for the next 5 years. Next 5 years, I'm going to get paid 50 basis points, except in year one, I actually get paid a little bit more, almost half of my first year commission when you take a look from 0 to 75. But they're going to take an income stream, and I expect that they're going to take that income stream over the next 12 years. And as long as there's a cash value, you get paid that trail commission. So you get paid the accumulation period of time, that was 5 years, but you also get paid the next 12 years as well. Now realize that value is going to be decreasing because I'm taking income, but you still get paid. So you're getting paid for 17 years. $100,000 premium into this. Think about adding $500 to your income each and every year. How many of those do you want to write? You know, you do 20 of them, that's $10,000 each and every year that you've built your business up. Now, I don't know if any of you have any succession plans, but I've been told that if I have more income that's predictable that's coming in, when I go to sell my business, it's going to be sold for more. If you take a lump sum each and every year, you're starting at 0 each and every year. If you take this trail, you're actually going to be building the revenue for your business each and every year. And I know you can add at least 20 clients each year, right? Question?
The 0.5%, you've explained that when the cash goes down, you get less. If it's going up with the index, you get more.
You do get more. You do get more. As the account value goes up, that 50 basis points is going to be based on that account value. And actually, I should point out too, we don't pay this every year. We'll actually pay the trail commission on a monthly basis. We'll help you pay your bills on a monthly basis with this trail option. It's kind of a neat deal. It's kind of a neat deal. Okay, so now we get to go ahead a few slides here, and let me see if I'm forgetting anything. I don't think I am. The 10% or the withdrawal features, we do have a benefit that actually lets a client roll over. Okay, here, where's my illustration? We let you roll over that 5.25% withdrawal. If the customer doesn't take that, they can roll it over into the next year. Now, it doesn't aggregate, so I can't get that 5.25 added up and get over 20% in 1 year. But if I win the lottery or I get an inheritance or I have a good sales year and I don't need the income, well, let's roll it over into the next year. They move it, they'll get up to 10.5% that following year as an income stream. Illustrations, this is one of the tools I would actually highly recommend when you're sitting down in front of your clients. And I wasn't a guy that used a lot of illustrations. Term insurance, here's the price. Don't use the illustration, right? A lot of different things, I didn't use the illustration. Disability insurance, it's all about stories. Health insurance, pretty much the same thing. With this, I would use the illustration because what it does is you can see, here's end of contract year, end of year age, income withdrawals, what the S&P did for the year, what the annual credited rate ends up being for the client. You'll notice that because it has the income rider on it, which the cost is only 80 basis points, and that's locked in guaranteed contractually, 80 basis points, we can't increase that. Unlike our competition, you know, there's one product out there that I have to beat up a little bit. They have an income rider fee right now of 1.15%. Guess what they can raise the fee up to? No guesses? 3%. 3%. I don't like that. And I don't think your customers like that. This product is 80 basis points locked in contractually. You'll see that in year 5, 6, and 7, we have 0% performance on the S&P 500. It's negative, right? Good news is client doesn't lose money on an index annuity, but we don't get to add any money to it. And when that 80 basis point fee comes off it, the cash values actually decrease. Question?
What happens in year 11 with a 10-year plan?
That's great setup. Question is, what happens in year 11? What do you want to happen? Do you want the benefit base to keep growing? Most people do, right? With our contract in year 11, if the cash value goes up, we'll actually add that growth, that $5,000 growth, to the benefit base. And that's actually shown on the illustration. So if you illustrate out like 15 years, you'll see in year 11, if the cash value goes up, that amount will be added to the benefit base. Exactly. Exactly. Based on the strategies, if they go the monthly cap, annual cap, or any type of percentage in between, that cash value is going to continue to grow. No, fee continues. Fee continues at year 11. It's one of the downsides. But there are some companies that the cash values actually have to exceed the benefit base before they start adding additional numbers to the benefit base. With us, starting in year 11, regardless of where that cash value is, we're going to add that dollar for dollar benefit to the benefit base.
And a year where the index is 0,
Still take the 80 basis points out, but that's coming off the cash value. And they don't have to worry about it getting higher. It's a great story. So why is this not too good to be true? If you look at the cash value of the contract, remember I said that we showed the example of $9,000. Well, that $9,000, if I have a $130,000 cash value, my $9,000 is going to be coming off each and every year, and my cash value is going to go down to 0 at some point, right? Well, that doesn't mean that I don't have anything left, but think about the benefits. I'm using the client's money first. I'm using the client's money first. But I am giving a great opportunity to actually get 8% growth each and every year and provide an income stream that they can't outlive. So my time's up. Great questions, folks. If you have other questions, please let me know. I'll be around here the rest of the day as well. But really appreciate your time and really invite you to do the comparison. Take a look at the numbers. I know if you're looking at income within the first 8 years, we're going to do better.